Welcome back, everyone, to another episode of Living Your Greatness. This is your host, Ben Mummy, and today we have a new guest to the show, and that is Grant Williams. So, for those of you that don't know Grant, he is a well-known investor, financial commentator, and co-founder of Real Vision, a financial media company. He's also the author of a popular financial newsletter, Things That Make You Go, So, Grant, welcome to the show. It is a pleasure to have you with us today.
Ben, thank you. The pleasure is all mine, I assure you. Thanks for having me.
Yeah, no, absolutely, Grant. Well, Grant, let's kind of get kicking here. Tell us a little bit about yourself. Where did you spend your formative years growing up? And what inspired you to pursue a career in finance, but as well as become a world-class investor, writer, and podcaster?
Yeah, it's where to begin. Well, I grew up in a commuter suburb southeast of London, about 15 miles out of the center of London, and I had a very ordinary middle class upbringing in the UK. It was a very different time, I guess, is the big difference. I was born in 1967, beginning of 1967. So, I really grew up in the 70s, and the 70s in the UK was a very interesting time. I mean, obviously it passed me by because I was just a kid. But looking back and reading the history and spending time thinking about what I was kind of soaking in during that time, but not really understanding. It was a very interesting time to be growing up. Obviously we had runaway inflation, we had industrial action, we had, basically a bailout of the UK by the IMF in 1976. We had flip-flopping governments, multiple elections, we had miners' strikes, we had all kinds of crazy stuff going on, all of which was against the backdrop of, terrorist activities in the form of the IRA bombings of London. And so, when you look back on that as a period in British history, it was a very turbulent time. Of course, none of this really affected me as a kid. I didn't understand that turbulence, other than, I guess, that the most prevalent turbulence for me personally was the IRA stuff, because if I was going up to London with friends or whatever, my mum would live in permanent fear that one of these bombs would go off, and so that was, I guess, really the only clear and present danger to me as a child. And again, in that way that you are when you're in your very early teens, as I was, or as a kind of 9, 10-year-old when I got up to London with my parents, I was completely oblivious to all this stuff. You'd see reports on the news of another bomb going off, and it just became ordinary. And I think, as I've thought back in later life about that time and try to think through kind of dangers that you see in the present, you realize the lesson you take away from it, certainly I did, was that the abnormal can seem extremely normal if it's all you know. And that was all I knew. And so I think as we've gone through, particularly the period, I guess for me, post 2000, for the vast majority of people investing in markets today, post 2008, I think back on the lessons I learned from growing up in those periods in the 70s, and realized that the world of QE and the world of buy the dip and the world of all the things that we've seen spring up post 2008 are completely normal to so many people, and they don't have any sense of the danger that comes with that. The same way I didn't have any real concept of the sense of danger that came with the terrorist attacks on London. What could possibly go wrong? Well, nothing. I'm a kid. I'm bulletproof. I don't need to worry about any of this stuff. So, I grew up in a very interesting time. I didn't. My dad was in the financial industry, but not as an investor. It was just he worked in a couple of merchant banks in London. But he had friends of his from those banks who we would spend time around as kids. And one of those, and I've told this story before, so for anybody that's heard it before, apologies for boring you. You can flick forward a couple of minutes. But my dad had a friend called Harry, who was my Uncle Harry, and he was just the coolest guy I knew. He had plenty of money. He had a cool job, even though I didn't know what the hell his job was. He had a cool house. He had all the toys. He was great fun whenever he'd come round. As a kid of 8, 9, 10, 11, 12, I would always gravitate towards him, and he would always have a new card trick to show me or a new joke to tell me, and I just thought he was the greatest guy, and I wanted to be like him. And it turned out that he was an FX dealer, whatever the hell that was. I had no idea what an FX dealer was, but that's what I wanted to be. Um, just so I could have the cool house and the pinball machines and the cool car and all that, all that stuff. And so that was kind of my aim in life. I worked along the way and kind of had filed that away in the back of my mind. Found myself taking economics at A level in the UK and found it really fascinating. And this was kind of the early 80s, when the Thatcher revolution was underway, and the idea of freeing people to try and make money and better themselves was very much in the minds of an awful lot of people in the UK, and it just naturally led me down that path into finance. I didn't end up being a foreign exchange dealer, but I ended up being in the Eurobond settlements department of a merchant bank called Robert Fleming and Co., which was a fantastic place for me to work, a fantastic organization for me to begin my career in. It was a very small investment bank, part of the Fleming family, the same Fleming family that spawned Ian Fleming of James Bond fame and Alexander Fleming of penicillin fame. And that bank were founded by, say, a very well established Scottish family a couple of hundred years prior, and they had connections with the Jardine family, who were kind of loosely the subject of the original James Clavell Shogun novels. They were a Scottish merchant family that went to the Far East and became a very dominant force in Hong Kong. And so I kind of fell into the Japanese markets, Japanese equity markets at the height of the kind of Japanese miracle, and kind of learned my craft as that market was really entering the blow-off phase of the bull market in Japan, which kind of happened in 86 through 89. And those were the formative years of my career. So I learned what a bubble was like firsthand, right out of the gates. And of course, I didn't recognize it for being a bubble. I kind of had this intuitive understanding that it didn't really make sense. But I think when you're new into any industry, any job, any role, you always think that you must be wrong and you don't really understand this, because how could you, the new kid on the block, you understand what other people didn't. So as much as it didn't make sense to me, I kind of went along with it because everybody else was riding the wave and everybody else was assuring everybody that the good times were going to go on forever. So even though I had these kind of nagging doubts in the back of my mind, I didn't want to ask the questions. Why? How can this make any sense? I just figured I need to go away and read more, because there must be something I don't understand. And again, my recollection of that Japan bubble bursting was not that it really burst as such. Rates started going up and the market started going down, and there wasn't a crash. There wasn't an 87 like event. We went through that in 87. And again, that was very early in my career. And that taught me a series of lessons that I've not forgotten to this day. But and we can come on to that later if you like. But the end of the Japanese bubble was kind of just a reversal. It peaked on December the 31st, 89, and started going down. And it's been going down pretty much ever since, which is a lesson in and of itself. So I never really felt like I wanted to be an investor or an economist or a financial thinker or any of that stuff. I just knew I wanted to be involved in the financial world. I found it so fascinating. And for me, it's become more over the years. I've become more interested in studying the human side of it and the emotional side of that world, because I think that's where the lessons are. I think that's where the foundations of it stem from. And it's something that will keep you engaged for a lifetime, as I found. And the longer my journey's gone on, the more interested I've become in that, and the more I think important that human emotional side has become in trying to understand the world we live in. So it's a very long-winded answer to a very simple question. So I apologize for that. But that's really how I've ended up where I am doing what I'm doing. I've been incredibly fortunate, from my earliest days in the business, to have had a series of of people that I've worked with and for who who've taught me so much, and a lot of it came from me being willing to ask the dumb questions. Um, and I think that's something that we all share, is that fear of being thought to be an idiot by asking a question that you feel certain someone's going to look down on you and go, "You really going to ask me that question? Are you that dumb?" And so I've found that having the courage to ask those questions is so crucial, um, because generally speaking, and this was a lesson that a friend of mine, Jay Chen in Hong Kong, helped me to understand much later. I think I understand it intuitively, but he kind of helped me understand it from a much more simple basis. Is that we as human beings, for the most part, there are always exceptions, of course, but we're hardwired to try and help people. If we can, if there's a way we can help people, and people ask us for help, um, it's just such a natural thing to give assistance to people, whether it be, you know, just advice, or whether it be, changing a tire for someone who you see stranded by the side of the road. I think that's who we are as a species. And so, I've been happy to be the dumb guy for my whole life. I've been happy to ask the seemingly stupid question, whether it was at school or at work. And over the years, I've been wholly delighted with the response that I've got from people in terms of taking the time to sit down and explain stuff to you. And so throughout my career, working with all these amazing people who took the time to answer my dumb questions, that's something that I've constantly tried to pay back. So whenever people want to ask me a question, I'll take as much time as necessary to kind of satisfy that question, because I've been in that place, and I know what it's like to not know an answer, and want to get someone else's input. And I think it's just so important both to ask the questions, and once you have the answers, to be generous with that knowledge and experience, and share that with other people and help them gain understanding to the questions of their own.
That was something that we connected on, right? When we had met backstage, I said, "Hey, Grant, something that I admire about you, is, you're humble, you're curious, you're very intelligent, but the biggest thing is you ask a lot of questions, and whether they're great questions or bad questions, you're constantly striving to asking, hopefully, a better question, right?" So a question I have for you is, if someone has like the desire, to develop personal responsibility or think independently, or, so then they can make, smarter investment decisions. If you were to think of, the most influential books that you've ever read over your life that hold great value for investors, what would that be?
Look, it's funny that there are so many, right? There are so many great books, and there are lists of great books, and you'll find a lot of familiar titles on all of them. Things like The Intelligent Investor by Ben Graham is foundational in a lot of people's education. Um, uh, and things like When Genius Failed by Roger Lowenstein helps you understand certain periods in time, and Barbarians at the Gate, and there are so many books that will help you understand specific events. Uh, what I've found over the years is, anything historical is guaranteed to be accretive to your experience. Because if you talk about the past and things that have happened, there are lessons in there, because what's past is future, and things that have happened before will happen again. They may not happen exactly the same way, but if you understand the past, you'll recognize similarities in things that happen in the future, and you can understand where to draw the lessons from. So, I think any book on financial history is so useful, and books on process, such as The Intelligent Investor. And I wrote a piece based on that not that long ago, because I just thought it was worth refreshing people's memory of that, are really, really helpful in terms of understanding how to do certain things. But, I find that many people want to know what, and many people want to know when. And of course we do, because if you have the what and the when, then it simplifies this whole challenge of investing a great deal. If you know what's going to happen, you know when it's going to happen, that's it. So I totally understand why those are the questions that people most commonly want the answers to. But unfortunately, um, I think a lot of us have the answer to the what, because again, if you read history and you understand how market cycles work, you can generally figure out the what. You know, you understand that at the end of a big credit expansion, you understand what's coming next, but none of us know the when. And so whenever someone wants to focus on the when, I think that's the wrong question. You know, I'm interested in the why and I'm interested in the how, because I think if you understand the why and you understand the how, uh, you can figure out the what, and you can figure out what the what means, and you can figure out how to go about uh, mitigating the risks from that or capitalizing on the opportunities from that. So, so spending too much time focusing on the when, to me, is a waste of time because you're never going to have that answer. No one can ever tell you when X is going to happen. So, you know, I've constantly tried to, when I speak to people, to understand the hows and the whys of what they do. Why did you do that in your past? Explain to me why you did that. Explain to me how you thought about that at the time. Explain to me how you went about adjusting when you got something wrong. Um, but looking into the future, which ironically is what we're all trying to do as investors, is the one part of this that we have no assurance that we're going to get right. You know, it all becomes a handicapping exercise. So, you know, I prefer looking to the past. I think it was Winston Churchill that said, you know, the farther back we look, the further forward we can see. And I think that's so true. Um, so, you know, there's these ideas of asking the right questions. And for me, I've found that the most useful questions, the most important questions I've either found myself asking or have been asked, always start with how and why, and never with when. And so I've constantly tried to learn from history in terms of books. And again, you know, off it's kind of abstract, but went back and read 1984 again recently, not a year or so ago. And you know, when I was at school, we read that book, and I read it virtually at gunpoint. You know, because it was set as a text we had to read, and it's kind of work, and you don't want to read it. And I read it, and I read it on a very basic level, and I answered the questions, and I wrote my essays on it, and you know, it didn't really sink in until later when those books are all back there in your head, and you start seeing quotes from it, or you remember quotes from it, and you go back and read these things with the experience of age and the experience of experience, and you suddenly realize that back then, if I'd have read this book, admittedly at a level I wasn't capable of reading it on, it would have told me so much about where the world was going. Similarly with Huxley's Brave New World, you know, if you read that again now, with the benefit of looking at what's happened over the last 20 years, you realize these things are instruction manuals. So, you know, I'm such a great devourer of history because I just think so many of the answers are there. So I would spend much more time reading books about history than I would books about finance, even though there's a significant overlap with the two. You know, another one that I've talked about often is The Lords of Finance by Liaquat Ahmed, which again is a historical novel, really, about real-time events in the post-war period amongst the central banking community of the time. And you can read that in two ways. You can read it as a chronicle of what happened 100 odd years ago, but you can also read it as a roadmap as to what's going to happen in the next 20 years, because the same problems are being faced by the cohort of today. So I'm such a keen student of history, and I'm such a keen advocate of following and reading and understanding history, because I think it's such a crucial foundation for understanding finance.
I appreciate that answer, Grant, because you know it showcases too. Like lots of times, I feel people always want that quick answer, like they're very impulsive. So, hey, what are the books so I could, get rich now and all that stuff. And so I love the fact that you took the time, to, educate people there, about the why and the how, understanding, your process, right? Of making decisions. But then on top of that, understanding how important history plays a role in investing. Like it never is like the same, obviously, but it does rhyme, right? And a question I do have for you is, what are then some why and how questions that investors should ask themselves as prompts, so they can make, better thinking decisions?
I think the obvious why for people is a reflective one. It's why did I get that wrong? Why did that investment go wrong? And that's a very important question to ask. To seek the understanding of why we got something wrong, because generally speaking, people commit personal capital, in a couple of ways. They either act on the advice of someone they trust, or a stock tip, someone who's made a load of money says, "Oh, you know what? You should buy Apple shares." Um, and those decisions generally are taken without the kind of requisite amount of thought, because in our own minds we've kind of outsourced the due diligence of those things. If it comes from a stock tip comes from someone we trust, then we tend to assume that they've done all the work for us and we don't have to do any work. And so, if someone says, "Hey, I think you should buy Apple shares," we a lot of people take them at face value, buy the Apple shares, and then without really realizing it, they find themselves sitting there thinking, "Well, what do I do now? What do I do now? I own these Apple shares," and we just sit and watch the price, waiting for the outcome we feel is almost assured. Oh, smart guy told me to buy these. I bought them. It's only a matter of time now before the price goes up, and I'll cash in. Um, but as soon as you take that leap and you say, "Okay, I'm going to trust smart guy A, and I'm going to buy Apple shares," something material has happened. Whether you like it or not, you've got capital at risk. And you own that risk now. That risk is yours. It's not smart guy A on the TV. It's not his risk anymore. It's yours. Um, because you have no idea how he may have structured his trade. You may have no idea how he's thinking from day to day, from hour to hour, from minute to minute, as news flow hits the tape, as the stock moves, as whatever happens. And I think people get into these things very casually, and uh, they don't own the responsibility for that, as well as they perhaps should do. Um, but I think when these things go wrong and we think, "Well, why did that go wrong?" It's a very natural human trait to kind of want to find someone or something to blame. Smart guy A told me to buy Apple and its stock didn't go up. How could I possibly have known they'd shut down the factories because of COVID, and shipments would fall and so the price would go down? I couldn't have known that. And a lot of that's true. But the real truth behind it is, look, as soon as smart guy A told me and I took it on his recommendation, as I said, I own that risk. So it's not smart guy A's fault for telling me to buy Apple shares. It becomes my fault for not selling them at the right time. It becomes my fault for not watching the news flow closely enough. It becomes my fault for not realizing every single day that I now have exposure to Apple. The risk is mine, not his. And I need to understand what's going on in every investment that I have, not relying on smart guy A to tell me when to get out. So that's one part of the questions that we ask ourselves in terms of why. Why did I get that wrong? But another really important question that very few people ask themselves is, why did I get that right? And I think this is so important to understand, because you can spend hours poring over ideas and end up saying, "Okay, I'm going to pull the trigger and buy whatever. I'm going to buy some shares in Google." And the price could go up, and we all think we're geniuses because we got it right. But did we? Right? Did it go up for the reasons we expected it to go up for, or did something else happen? And it doesn't change the outcome, but you can use the answers to those questions to refine your investment process, to getting things right for the wrong reasons, there are so many lessons in that. I expected this to happen and the stock to go up. This didn't happen, but the stock went up. So if all you care about is the number going up, the fact that what I thought was going to happen didn't happen, is that a catalyst for a future rise? Is the stock going to go up more because I expected this to happen and it hasn't? Has the fact that the stock gone up meant that the reasons I thought it was going to go up are no longer valid, in which case, should I get out? There are so many questions in why did I get that right that people spend far too little time thinking about, and they're equally as important because, every day we start again, every hour we start again. There is news flow that can happen every minute of every day that can affect the decisions we've taken and the reasons we've put forth for doing the things we do. And so when people fixate on the number, when people fixate on the price and whether it's gone up or down, you're leaving so many opportunities to learn lessons behind you by not asking why did I get that right as well as why did I get that wrong. So I think they're really important questions. And again, the how question that you asked about, the how is really a historical question, right? If you're asking how, you're asking, okay, how do I manage this? And realistically speaking, if you want to understand how to manage this, you're going to look at past experiences, either yours or other people's, to learn how they've managed a similar situation. Or you're looking to understand your temperament, or you're looking to understand very specific changes in a company's news flow that have already happened. The how questions don't speak to the future unless you're asking, how might this stock perform in here? And really, none of us know that. Again, it's a toss-up question. How might it perform? Could go up, could go down. We don't know. So I really like to focus on those two things. And the hows tend to be either reflective. How did I handle this the last time I got something right or wrong? Did I sell too early? Did I sell too late? Did I not hedge the risk when I should have? How did such and such a person handle being wrong? How did such and such a person handle being right? What did they do? Did they double down? Did they cut? Did they, there are so many lessons that we can learn from other people, but we can learn just as many from ourselves. The more we do this, the more we make mistakes, and the more we should be learning to not make those same mistakes twice. Because in this game, you're going to make mistakes, and you're going to make a lot of mistakes. But the critical thing here, and the unforgivable error that people make, is to not learn from our own mistakes. It's fine to not learn from other people's, because you haven't lived them, and so you haven't felt the pain those people find. You can read about something somebody got wrong and all the money it cost them, and you can go, wow, that would be painful, and I must remember that. But then in the fog of war and the fog of positions going against you and the fog of market dislocations, we forget other people's lessons, but we tend to remember our own because they were so painful. So, I've said to my kids their entire lives, there are things I can teach you, but there are things that you have to learn. And it doesn't matter. I can try and teach you those things, but I don't expect you to listen to me. I don't expect you to learn from me, because none of us do. I didn't learn from my parents the things I should have learned until I screwed up. It's the whole don't touch the stove thing. And that's okay. It's okay to make mistakes as long as you learn from them. It's not okay to make the same mistakes twice, because then you're wasting hard-earned knowledge, real world knowledge of what can go right and go wrong and how to deal with them.
Absolutely. Yeah, no, Grant, I really like how you broke down, both the why and the how, and, really crucial, but also simple questions that you could ask, whether it's from your own successes or failures or learning from others, right? And seeing that kind of, side of the process, right? But, something that I want to touch on, you had mentioned about, there's a lot of individuals that sometimes don't take that personal responsibility, right? They follow the herd kind of mentality, and I've also heard you, talk about that in kind of many of your, talks. So a question that I have for you, based off, when I just heard that, is the fear of missing out is a concept that we hear a lot, that a lot of investors could probably even relate to themselves, and that can sometimes lead to really poor investment decisions, right? They don't understand what they're doing, or kind of like you said, like maybe they're going into stock like Apple or Google, but they don't know why they're going in, right? Or sometimes we also see it with, random hot investments, right? Like crypto or kind of meme stocks, and again, like they might not understand why they're going into it. So a really important question that I want to kind of pinpoint here is, how can investors make the mindset shift from the fear of missing out, so FOMO, and then go towards more of a fear of screwing up, which I hear you speak about a lot.
Yeah, look, FOMO is a very real thing, right? And I think the best story I ever heard to represent the danger of this was the great Stan Druckenmiller. Stan was being interviewed on stage by Ken Langone, and Druckenmiller very famously back in the late 90s was talking about the dot-com bubble and how it was a bubble and how things were priced at crazy expensive values, and it was an accident waiting to happen. And he was working with George Soros at the Quantum Fund at the time, and there were a group of guys sitting next to him or nearby him on the desk, young guys making money hand over fist by investing in this bubble. And Druckenmiller very famously just couldn't take it anymore, and he piled in at the very top and lost $1 billion of Soros money. And that's a very well-known story. It's one that Stan has told many, many times. But again, the question that Langone asked him at that time was really important. He said to him, what did you learn from this? And I thought Stan's answer was absolutely fascinating. He said, nothing. I didn't learn anything from this because I knew I shouldn't have done it. And therein lies the problem we all face. If Stanley Druckenmiller can get caught up in FOMO, then none of us are immune to it. And I mean none of us. So this FOMO thing is very real, and you shouldn't be down on yourself for getting caught up in it, right? Because it happens. The trick is to understand that I'm in something because I don't want to miss out on it. And I think the crypto thing is another perfect recent example of this. When you said a lot of people don't know why they got into crypto, they do. They saw a chance to make crazy money really easily and really quickly. That's why they're in. Or they saw their friends making stupid money really quickly and really simply, and that's why they're in. That's it. That's really it. And you saw what happened, right? But if you were honest with yourself, and said, I'm buying crypto because I see the opportunity of making a fast buck here. Just that mindset shifting, knowing that that's why you're in crypto, would in many cases have gotten you out when it didn't go to $500,000 like a lot of people said it would, right? It went to 60,000 and went from 60 to 40. If you acknowledge that you were in that to make a fast buck and you got in at 30,000, seen you double your money, you probably would have cut long before the people that rode it all the way down to 13,000 because they believed in the $1 million Bitcoin story and didn't want to give up on the dream. So it's okay to be in stuff because you think you can make a fast buck, as long as you realize that if you're not going to make that fast buck, it's time to get out. It's okay to experience FOMO and act on it if you understand that's what it is, and you don't want to over intellectualize it because you don't want to admit to yourself or others that you've got FOMO. It's okay, right? We all suffer from it. So I think that's a really important thing for people to understand, this idea that FOMO is very real. And the shift you talked about to what I termed the fear of screwing up, the move from FOMO to FOSU is a real one, and it's because people have been burned by FOMO. It's because people did lose faith in things like Bitcoin. And I'm not picking on Bitcoin here before the Bitcoin lovers in the crowd think I'm picking on Bitcoin or not. You brought it up, so you blame yourself, Ben. But there are a lot of people who bought into the idea that Bitcoin was going to go to the moon and got burned by it. And those people now rightfully have fear of screwing up. And when the market regime changes, and I think the market regime has very definitely changed, it's a much more prudent strategy to have fear of screwing up than it is to have fear of missing out. Because, bear markets, you get these ferocious rallies. Um, and if you fear missing out on these ferocious bear market rallies, it is a guaranteed way to the poorhouse. So being more cautious and being more worried about screwing up and buying into another one of these bear market rallies will, over the long term, over the life of bear markets, save you from making great mistakes and save you an awful lot of money. So, when buy the dip becomes sell the rallies, FOMO becomes FOSU, and that's a smart way to invest. It's a smart way to speculate. Tighter stops, more risk management, more caution. These are things that you recognize once you've been through the cycle and you've lost your shirt by being too cavalier and believing that the good times go on forever. The second time around, you're more cautious, and the third time around, you make your money because you recognize the bear market for what it is, and you can make money out of it. This is just a natural learning circle of markets.
I really appreciate that answer there, Grant, and especially the fact that you kind of brought up the whole idea too of that, bubble vision too, where sometimes investors chase, right? And again, like it all connects to, the fear of missing out. But something that like I know you've said before, and it's something that I really honestly admire, something that you educate about is a lot of investors always think of, okay, the only way to make money is knowing when to buy and knowing when to sell, right? And you even gave some points where sometimes people buy high, and they get hurt, or maybe they buy low and they do well. But I know I've heard you speak before, like for example at Jay Martin's conference, where sometimes the best things that investor needs to do is sometimes to do nothing at all. So what do you mean about that? And how could you explain this, to better educate, investors how to know when to do that?
Yeah, look, on every given day and every given moment, you have three choices. If you're in the markets, if you're speculating or investing, you can buy, you can sell, or you can do nothing. And the doing nothing is, for many people, the hardest thing of all to do, because you kind of feel like I should be doing something. The price is always wrong, right? The price is either too low or too high, and I should do something about that. And people will tell you that the price is right because of efficient markets and what have you. I prefer something John Burbank said to me 5, 6 years ago. Price is a liar, and I think he's absolutely right. And so people get caught up in this crusade to prove price wrong, right? I need to do something. I need to act on this price because I'm right and the price is wrong. Doing nothing is hard, right? Because what doing nothing essentially is admitting is that I don't know. I don't know if I should buy. I don't know if I should sell. And it's tough for us in the world of investing to admit that I don't know something, because there's this desire to feel like we know everything all the time, and that certainty that we crave before we put money into something. We won't admit to ourselves that we don't really know what the hell's going on, and it's okay. The big difference, I think, in the last year or so is that until the last 12 months, doing nothing was a very expensive thing to do, because not only did you have the FOMO aspect of this and things were going up and markets were going crazy, but you weren't getting paid to do nothing. Now you are. Now you can do nothing and get paid 5%. And for new investors, I think that's an important thing to understand. I think people who've invested for a long time intuitively understand what a big difference that makes to people. That I can do nothing and be paid to be patient. And being paid to be patient is one of the great opportunities in investing. And it's one we've been denied of for 15 odd years by central bank policy. So if you can be paid to be patient now, and you can be paid to be selective about what you invest in, and more importantly, when you invest in it, it's such a huge tailwind in terms of sensible stewardship of precious capital. So that's the thing that I think people need to understand about doing nothing is when interest rates are zero, yes, I understand you kind of feel like you're losing ground by doing nothing. And in some ways you were, but again, this idea of the irreplaceability of capital is something that we've lost over the last several years in terms of this zero cost of capital, money's free. It tends to shake us out of this idea that capital is scarce and capital is irreplaceable, and losing it is by far the biggest crime in investing. Losing your capital is the one thing you just can't do. And so if you're paid to be more careful with that capital, it just instills a better mindset in terms of, well, I don't need to invest in this now because I get 5% just to do a little extra due diligence, or make sure that I'm even more comfortable that market conditions are going to go my way in the future. And it's a wonderful thing. It really is. And I think what we've seen is a lot of older, more seasoned investors, certainly the ones I talk to, are rubbing their hands at getting paid 5% to sit and wait. Whereas a lot of younger investors are still are taking the mindset that, well, 5% doesn't compensate me for 6% inflation. And yes, that's true, but it doesn't work that way. It's not a straight apples to apples comparison. And being paid 5% to wait 6 months, and getting an opportunity in that 6 months to make 10, 20% returns is a much more sensible use of your capital than, trying to find a 6% return because you want to stay in with inflation. And again, these are things you learn from going through these cycles, from investing in different periods, from investing with different costs of capital, and seeing how those next 10 years have played out. And there's no substitute for experience. So again, this comes back to the things you can be taught and things you can learn. And there are a lot of people out there with gray hair like me saying, hey, being paid 5% to sit and wait is really good. And there's a lot of people with blonde hair and dark hair and, who could run rings around us on the track saying, no, come on, you got to get in, you got to get in. And I totally understand it. And they will learn lessons of all kinds, and they will hopefully take away important learnings from each of those lessons and incorporate those into their process going forward. So, everything I say, some of it you can listen to, a lot of it you have to learn yourself. And that's kind of the challenge is can I take the lessons of other people and incorporate them into my own process without having to have learned them the hard way? That's the real skill. And that is the edge that some people have, is that they can listen to receive wisdom and incorporate it without having to have learned it. And that's a way to save yourself an awful lot of pain.
I really appreciate that answer, Grant. I think sometimes it's important, and you kind of, highlighted that, being steady Eddie, especially in times where, things are so volatile, right? And, to protect yourself, right? To protect your, your kind of war chest and your financial confidence. But, something key that I want to highlight is, I think you kind of nailed it there when you were talking about how, there's some very experienced investors that really know how to play the game right now. And then there's some other investors that are more impulsive, or, looking for those fast, gains. And kind of like you said, like it could be an opportunity if they know how to understand that that's speculating, and that's not investing, and that they're doing it short term. But something that I really want to highlight that I think will add value to my listeners right now is, how do you differentiate between investing and speculating? And how do you balance this, in making good informed decisions?
Look, there's Jack Nicholson's character in The Departed says this great line towards the end of the film, where he says, I'm a product of my environment. And we all are. We're all products of our environment. And the environment for the last, I don't know how long, almost 15 years, has encouraged speculation. And the Fed have been clear about this. They've actively encouraged speculation. They've encouraged risk taking. So if you've entered markets in the last 10, 15 years, understand that you're a product of that environment and you are a speculator, and admit it to yourself. Because I think the first step that we all have to, the first thing we all have to own is who and what we are. I'm not a speculator. I don't want to be glued to my screen watching every tick of every stock. I've done that in my career as a trader, because I had to watch every tick, and I had to understand what markets were doing and be much more nimble. I don't want to do that anymore. So I choose not to. And it's absolutely fine to be a speculator and to be a trader and live in the moment and live by the minute, but own that. Understand and admit to yourself, this is what I am, this is who I am, and this is what I do. And if I'm going to do that, I have to be in constant touch with the markets. I have to watch every tick. I have to live and breathe markets and be ready to change my mind and act on that change of mind at every second of the day. That's what speculation is all about. Speculation is owning that. If you're an investor, you have a different set of potential problems to own. If you are an investor and you want to commit capital for a longer period of time, again, you have to stay in tune with the investments that you've made. That doesn't necessarily mean minute to minute, but it certainly means a constant reevaluation of your investment case. Do the reasons I bought this stock and invested in this stock over a 5-year time horizon, have they changed? Has central bank policy changed to the detriment of my investment case? We all have to own that. But if you're an investor and you have a longer time frame, by definition, you have to be more patient, and you can't get chased out by the daily fluctuations of a stock unless those fluctuations are for a very specific reason that negates your investment case. And so you have to have that intestinal fortitude to be wrong, because I think every investor will tell you that if you invest over 5 years, the chance of you picking the absolute low of a stock and it going the right way for your investment every day henceforth from the moment you buy it is effectively zero. So understand that you're going to be wrong, and you might be wrong out of the gate for several months. And if you're wrong for several months, was it your investment case that's wrong? In which case you need to admit that and get out of your position. Or is that investment case still robust and the markets are just doing what markets do and testing your will in the short term? It's quite possible. If you're a speculator, some of the best speculators I've spoken to, I spent some time interviewing Vic Sperandio in Dallas recently. And, it was amazing to me to listen to Vic say, if I'll put a position on as a speculator, if I'm wrong, I'm out. And that understanding that if I'm not right immediately, I have to get out, is a whole different mindset to being an investor. So, as I say, I think the key lesson here, the first thing to do is look in the mirror and ask yourself, what am I? What kind of beast am I? Am I a speculator? Am I an investor? And once you can be honest about that, then you can act accordingly with your investments when they go against you. You can cut them quickly, or you can be more patient. But understanding who and what you are is sometimes difficult to admit. 'Cause I think deep down, a lot of people who are speculators think of themselves as investors, because there's something more thoughtful. There's a certain amount of cachet with being an investor. Everyone likes to think of themselves as investors. Some people love the thrill and the buzz of being traders or speculators, and they'll own that. But I think there are far more traders that think of themselves as investors and get that wrong than there are investors who think of themselves as traders and get that wrong. So I think there's much more chance that you're a trader who thinks he's an investor. And if that's the case, then you need to rethink that, because it's a dangerous misconception to have.
I love how you broke down, the differences of like the two of them. And that question, which for me it resonated, but like look in the mirror and kind of know what you are. Are you an investor? Are you a speculator? So I really appreciate that. I am an investor first. Like that's the way that I invest, even though I am a millennial and a young buck. But a question I have for you is, you have spoken to some pretty world-class investors across the world, with Real Vision as well as with your podcast now. So what do you believe separates a good investor from a great investor? How do we go from good to great?
Look, I think we've covered a lot of that in this conversation, Ben. You know, the 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 great the great investors that I've encountered over the years do all the things that I've spoken about. Recognizing what they do and being able to do it are two very different things. So as the years have gone by and I've spoken to these guys, I've tried to incorporate all the things I've talked about here into my own process, and I've learned those from talking to great investors. Some of it I've learned through experience, um, but a great deal of it I've been fortunate enough to talk to so many people, um, all of whom are way smarter than I'll ever be, and having the humility to understand that and saying, "Hey, I can learn from these people. I can learn from these great investors about patience, about discipline, about owning what's gone right, about owning what's gone wrong, about being flexible, about being willing to admit to ourselves that we're wrong, to being able to admit to ourselves that we should have learned this lesson and then not making those mistakes again." What we've talked about in this hour is really the distilled knowledge of a career of mine, and the second half of that career has been spent talking to people and understanding exactly what we've spoken about. These are the lessons that I've picked up from them, uh, and I've tried to incorporate. And I think if you can do that, if you can listen to what we've talked about, um, and incorporate those lessons, I don't see how it won't improve you as an investor or or as a speculator. I don't see how the lessons that we've talked about and I've shared here, because I've learned from all of them. And I'm not pretending for a moment that this wisdom is my own. This is my takeaways from the good graces of all these smart people who've shared their wisdom with me. And I'm just happy to pass it on and talk about how it's improved my life and my investing. Um, but it's not original, you know. I don't take any credit for any of it. I've learned all of this from other people, um, and I recognize that, and I'm humbled to have had the chance to learn it, and I'm delighted to be able to pass it on.
Well, I really appreciate, your humbleness there, Grant. And like it speaks words of who you are, of again, your curiosity.
Hey, I've got a lot to be humble about, believe me.
Yeah. Yeah. And also, all these, great individuals that you've kept your personal biases on like the side, you've protected your blind spots, you've enhanced, your circle of competence. So I really appreciate that about you. Something that I want to move to, it's one of my last questions, Grant. The purpose of my podcast is really to inspire millions of people across the world, to enhance their overall well-being and, achieve greatness. So what is your definition of greatness?
Oh boy, that's a tough question. Um, you know, I, I I go back to Justice Potter Stewart's definition of pornography, in a landmark case in the Supreme Court. He said, "I can't define pornography, but I know it when I see it." And I think I'm that way about greatness, and greatness comes in many forms. I watched Michael Jordan, up close, and there is so much greatness in so many aspects of what he did on the basketball court, and in the way he dedicated himself to sport. I watched Tiger Woods, same thing, just at his peak, one of the most transcendent athletes in all the sports, and what he did for the game of golf outside and away from the golf course is remarkable. Go to Muhammad Ali, in boxing, and far beyond boxing. That's true greatness. And you go to the world of investing, and you look at the Stan Druckenmillers of the world. And Stan Druckenmiller is one of the greats. Warren Buffett is one of the greats. I think it's very difficult to define it, in terms. For me, um, I look at people who are consistent. I look at people who, over time, have proved themselves over and over and over again. And, in investing, there isn't a spotlight so much. Some of the greatest investors I've met um, live very, very quiet lives, deliberately away from the spotlight. And I think the example of that most people would be able to kind of identify with is my dear friend Tony Deaton. Tony Deaton, bless his heart, what he did for me in agreeing to let me interview him when it was the last thing he ever wanted to do was attract any publicity, but he very, very graciously allowed me to interview him. And that interview, that conversation, changed people's lives. And I know because I've had hundreds, literally hundreds of emails from people who talked about that conversation, how it changed their lives. There is a greatness in what Tony does and the way he does it and the humility with which he does it, not seeking the spotlight, which is greatness to me. I think Tony is a great man, for so many more reasons than that conversation. I've gotten to know him as a human being, and I think he's a great man. And I've come across so many people like Tony in the last 10 years who are inspirational to me in the way they conduct themselves, the way they do what they do, their consistency, their values. Um, uh, and it's those things to me, if we're talking about the world of finance, that kind of come together to form greatness. It's how consistent are you? Um, how well do you own your mistakes? How generous are you with sharing what you've learned with people? How successful are you at putting ego aside? And I think that's one of the big problems in finance is ego. In athletics, it's okay because you need that ego to compete against the other guy. Michael Jordan, going back to that example, had one of the biggest egos in sports, and he needed it. He had to believe he was the greatest every time he walked on the basketball court, and he went out to prove that. And the stories of his, trash talking, and the stories of his taking what he perceived as slights as fuel to propel him to even higher levels are legendary. But in investing, you don't have that. There is no body that you are competing against. You're competing against yourself, your own emotions, your own demons, and the market. And the market is nothing more than the collective sum of the emotions of every other human being that's involved in that. So there is no room for ego in investing. It's the one thing that I've found is almost universally detrimental to your performance. And yet, because success in finance is by many people defined by money, it's difficult for a lot of people to put ego aside because they equate the two. And I think that's the single biggest impediment. For me, if I see ego, I'm never going to see greatness. I just don't believe that in finance you can be great and not put your ego aside. And that's personal. I think other people will disagree with that, and I can understand why. But I think that comes down to a personal value system. And I think, as I said, I recognize greatness when I see it. The closest I can come to giving you a kind of a definitive answer to that question is to take the inverse and say, if I see an inability to put ego aside, I don't think I'll see greatness from that particular person.
Absolutely. Yeah, no, that's a beautiful definition, Grant. I really, value, for sharing your perspective as well as all those examples, both in athletics as well as the investing world. And I definitely think too that, putting that ego away and being a good person and, having true values and standing by them speaks words, right? And an example I just want to add to your definition would have been, in Vancouver, at that huge financial conference, BRIC, with Jay Martin, seeing some of those top high net worth investors or, macroeconomic thinkers, and most importantly, seeing them behind the stage, seeing who they truly are. And one that stood out to me was Rick Rule. And, not because of, his name or, how he's popular or anything like that. Like for me, it was seeing how generous this gentleman was, after, an hour presentation and, a crowd of, let's say, hundreds of people, and just being a person first. And unless he doesn't have another interview, really being there for them.
Look,
So
Rick Rule in this industry, Rick Rule encompasses everything we've talked about. And if you want greatness in this industry, then look no further than Rick Rule, because he has been successful. He's learned from his mistakes. He's incredibly humble. He's incredibly generous. I mean, he's been such a great friend and mentor to me. And if you actually go back and listen to this conversation with Rick Rule in your head, you will find that he ticks every single box that we've talked about in this conversation, every single one. And I've learned so much from Rick over the years, both from a professional side, but also from a personal side. He has become a dear friend, and he is just a wonderful human being. And I think at the end of the day, the people who've met Rick will remember him far more for who he is than the money he may have made them, or the investment tips he's given them. Anyone that's lucky enough to spend real time with Rick will forget all of that and just realize that they've just spent whatever length of time in the company of just a thoroughly decent human being. And I think that's way more important, frankly.
I totally agree with you, Grant. And Grant, my next question, now that you have a good feel of my podcast and what it is all about, who is a future guest, like someone that you think is truly great that you would like to see on this show?
Oh boy, how long have you got? I mean, I could give you a list as long as your arm. I think there are so many great thinkers out there. And look, in terms of great human beings, the first name that springs to mind is my dear friend Stephanie Pomboy. Steph is just like Rick. She is the most humble, the most generous, the kindest person you could ever come across, and such a world-class thinker. She will hate me for saying all of this, which only inspires me to say more of it. But she's someone that thinks differently to people in the same business. She's someone who's not afraid to say things that she knows people will think sound dumb. If she thinks something's worth saying, she'll say it. But she is instilled with just this incredible humility about her talents and herself that I aspire to. She's just a wonderful person. So if you want one future guest that I think people can learn an awful lot from, not just about markets and the way she analyzes data, but about being a better human being, about being a better thinker, then Steph Pomboy is at the very top of that list.
I love that, Grant. Well, I really appreciate that recommendation. And, it's part of my desire, to bring her on at some point and showcase her human side, as well as, her talents of, giving and kind of sharing that knowledge. And Grant, the last thing I just want to say here is, where can my listeners go to connect with you online?
Oh, very simple. Everything you could ever want to know or not know about me, you'll find at grant-williams.com. And I'm on Twitter at TTMYGH. So it's nice and easy.
Awesome, Grant. So I'll make sure to put that in the podcast notes. That way it's easy for everyone to know where to go. And I want to just take this last little moment, Grant, to really thank you for being here. Thank you for your time today. Thank you for your generosity. It was truly appreciated. And I'm sure all my viewers as well felt that way.
Ben, you're very welcome. If I've helped anyone, then I'm absolutely delighted. Thanks for giving me the platform to waffle on for an hour, and I appreciate the chance to be here. Thank you.